In this video, we are going to talk about the 4-hour time frame. I will break down the key things to look for and how you can identify the short-term bias with the highest probability moves. So let's get into it. So how are we actually going to use the 4-hour time frame? The way I personally use it is very simple. The 4-hour is my point of interest. It's where I look for trade opportunities, not entries, but the areas where I expect price to react from. And in this example, I'm going to show you how you can use the 4-hour time frame with more frequency and actually connect it with your lower time frame execution. So let's go through it step by step when I open the charts. Starting from the 4-hour time frame, what did I see? I saw that price had this 4-hour fair value gap that was already inversed. But at the same time, price was also respecting another bearish 4-hour fair value gap. So straight away, there was conflict. There wasn't a clear bias. And then as the 10 a.m. candle opened, we formed another bullish fair value gap, which made things even more confusing. Now, why is this confusing? Because on one side, price is respecting a bearish fair value gap, meaning it's showing weakness. But on the other side, it has already inversed a fair value gap and is forming bullish structure. So you have mixed signals. So what do I do in that situation? I don't force a bias. I simply mark out the important areas. I marked out the bullish fair value gap because if price wants to go higher, it needs to tap into it. And if it wants to go lower, it needs to invalidate or inverse it. So now I have a clear point of interest. Then I move down to the 15-minute time frame to refine the idea. And on the 15-minute, what do I see? I see these equal highs, very obvious liquidity sitting above price, so naturally. My expectation was that price would open, take those highs, and then continue. But the market doesn't always do what you expect. Instead, price opened, took the pre-market equal highs, and then dumped straight into the lows without giving any clean retracement. So, no entry there. But here's the key part. Where did price actually go? Price went straight into the 4-hour bullish fair value gap that we had marked earlier. And once price got there, it started showing weakness. Now look at what's happening inside that area. We get a liquidity sweep, we get inversion behavior, and at the same time, if you look below, you see very clean equal lows. And not just that, there was also news at 10:30, Powell speaking. So I stayed patient. I didn't jump in early, but mentally, everything was starting to line up. We had equal lows below, we had an inverse fair value gap, and realistically a lot of traders would have taken longs there, which means their stops are sitting below. So what am I thinking? Those longs are likely going to get trapped. And that's exactly what happens. Price comes down again and takes those lows now. At this point, we no longer have equal lows, the liquidity has been cleared, and there's no major news left. So now I ask myself, where can price go next? And if you look above, we have clean low resistance liquidity resting above. So now the narrative shifts after taking sell-side liquidity. Price can move higher. So I go back to the 15-minute time frame and I identify a 15-minute fair value gap. I mark out that area and that becomes my target. Now coming back to execution after the sweep of equal lows, price starts displacing higher and inverses those bearish fair value gaps. And this is the confirmation I was waiting for. I then look at the lower time frame and see an inversion fair value gap forming, and that's where I take my entry. Stop loss goes below the low that was just formed, and my target is that 15-minute high I marked earlier. And as you can see, price moves cleanly and delivers straight into that target. So this is how you use the 4-hour time frame. You're not using it for entries, you're using it to frame your trades, to identify key areas, and then you combine that with lower time frame confirmations to actually execute. It's all about building a narrative, letting the market show its hand, and then stepping in at the right moment. So that's how you use the 4-hour time frame properly, not to guess direction, but to frame your trades and identify where price is likely to react. Once you start combining your 4-hour points of interest with liquidity on the lower time frames, everything begins to make much more sense. You're no longer confused by mixed signals. Instead, you're letting the market develop, waiting for confirmation, and then executing with clarity. The key is patience. You don't force trades just because you see a level. You wait for price to come into your area and show you intent. And when you do that consistently, you'll start to see how clean and structured these moves actually are. If you found this helpful, make sure to like and subscribe, and I'll see you in the next one.